Welcome back. In the beginning, obviously, we talked about, or last week, I should say, the first live, we talked about, mobilizing and your savings and income sources, identifying those things, really getting your expenses of how much you're planning to spend. If you didn't know that, then that's where we came up, the replacement income rule of 80%. Today, we're going to dive into the topic of pulling your money out of savings and the various strategies that you can choose to do so. At the end of the slide deck, we'll also give a simple, very simple actually, case scenario or case study, if you will, case scenario on pairing one of these strategies that we talk about today with risk, and that will pair really nicely with next week's piece on assessing your portfolio risk. And then later next week, I believe we have a pre-recording that I'll have done that we'll do that will go out. I believe it's next Thursday on Social Security. So as always, if you have any questions on anything as you're going along, something you don't understand, something that you can't quite put together maybe for your personal situation, feel free to email me. And you all have, I think, all of that information. I will share it with you at the end of the video. So today we're going to talk obviously about withdrawal strategy and how you plan to take your money out can be and is a lot of times just as important or more than how you saved it. But first, we need to take a minute to talk about a more basic question that I get quite often. And that is the question that really was one of the ones that initiated the Pre-Retiree Academy, believe it or not. And that question is, okay, I'm about to retire. Like, how do I even get my money? Like, how does that work, right? And so that's what we're talking about here. So really, there's a couple of different choices. Number one, you can leave it in your employer savings plan, your 401k, 403b, or you might choose to roll it to an IRA. So we're going to delve on those two topics initially. If your money is staying in an employer-sponsored plan, then it will be important that you'll need to contact your custodian for the specific options available to you and within the plan. Part of that, and you can also reach out to me. We have this information, obviously, as well. So you don't have to contact the custodian every time. But it is different from plan to plan because distribution options and rules become plan specific to each plan. It's not like a universal option is out there, at least today. So in my experience, typically custodians, so 401ks, 403bs, typically charge withdrawals for taking distribution. So let's say you're able to withdraw it on a quarterly basis. Each time you take one, those custodians generally will charge you a fee for those distributions each time you take it. Some plans will allow you to set that up recurring. Some plans you'll have to fill out paperwork each time you go. Every plan is different. I can't stress that enough. In addition to that, kind of what I was alluding to, some custodians or the plan itself might limit the amount of the distributions that you can take in a year on top of that fee that they've charged. So some plans might allow monthly, which is ideal. Some plans, I have one plan that only allows one a year. So those are things to consider when you're looking at the employer-sponsored plans is, what fees are you going to get? What is how often are you able to pull that on a regular basis? Can you set up recurring? Makes your life a little bit easier if you do that. Also, it's industry standard in a 401k world that those custodians are going to withhold 20% on each distribution. Very few record keepers that I've seen allow less than this. It's a very specific scenario. So the withholding will automatically, in most cases, be 20%. If your effective tax rate is 13, they're still going to withhold 20%. You'll get a return if you overpay for the end of the year. But that's industry standard. On the positive note, you can get help from the record keepers on all kinds of different things in terms of accessing your money. You can call that. They can help set up those things for you. But they also will help you determine your required minimum distribution. For some people on the call, that might be age 73 as a required minimum distribution. For others, it will probably escalate to 75 in the next few years, depending on when you reach that threshold for that. Okay. So the basics of 401 and 403B, most have fees, at least today. I kind of expect some of this to change over time, quite frankly. And your distribution options are driven by the plan rules. For an individual retirement account, typically there is a bit more flexibility when you set up an individual retirement account. So whether that is a Roth IRA, that you transfer maybe Roth savings from your 401k to, or traditional or rollover IRA. Traditional rollover IRAs tend to be the same, or even if it's a SEP IRA, which is usually for self-employed type people. IRAs in most cases do not have fees associated with taking distribution. What I typically see is people say, okay, I want to do a monthly. I want it to come in this amount. You can have it set up automatically, or it comes in every month. You can also take it a la carte. So you can call the custodian of the IRA. If there's an advisor involved, then you can call the advisor to initiate those in most cases as well. You're definitely not locked into an amount exclusively just because you set up a recurring amount. You can take more, you can switch and take less. There's a lot more flexibility when it comes up to that. You have the option to choose what your withholding is if you want to do it all. You can withhold zero and then pay estimated taxes that way. Lots of ways to achieve that as well. However, just through an IRA, most of the time, in most cases, custodians will not help you figure out what your RMD is. If you work with an advisor, then that would mitigate that circumstance and need for that. So there's no right or wrong answer between those. Typically, for most cases, and when I'm doing one-on-ones, it really comes down to the cost associated, the investment options. But typically I see people roll to IRAs for the flexibility, and you get more options because you can choose more fixed income options, which become more attractive to those who are retired. You want to lower that volatility. And there's more options that you can get in most cases because you have options to the whole marketplace versus in the plan, it's just to that. So I see people roll to IRAs more often than not. But if you're not going to be taking money out of that account for quite some time, then in general, it makes more sense to leave it in your plan. You don't have to take it out by a certain time, just until that required minimum distribution hits. So fees tend to be a little bit less on the plan side in general. So if it's going to be a while before you take any kind of distribution, just something to consider, pros and cons for both on that. If you have any specific questions about your personal situation, happy to help with that. So when we're talking about withdrawals, there's a lot of considerations that we all have to kind of think about. Not all of these are applicable to everybody on the call, but these are things to think about. Can you delay taking withdrawals? Remember we talked about that a little bit, the three questions: how much money do I need? When do I need it? And the last one's for how long? If you can wait and delay taking withdrawals from those savings, it is only to your benefit of helping making that money last longer. There are ways like, can you live just off the income that maybe your portfolio produces, meaning dividends, and those kind of things. Does it make sense for you to take Roth early as part of that from a tax efficiency standpoint, or is it better for you to delay that? There are reasons for both. The most tax efficient way is to take out your Roth first, and then avoid paying those taxes. But what that generally also does is delays the pre-tax portion or the traditional portion later, which might increase the amount of your RMDs. There is a room for planning for both of those things. Obviously, withdrawing too much too soon is a concern for a lot of people. It's really nice to know as you're going in there of what your spending bumpers can be. If you keep it between this and this, then you will be okay over your point in life expectancy. I always recommend looking at that. There are reasons for some people to maybe accelerate withdrawals, particularly when it comes to charitable giving. And then I'll recommend toward the end of the program, different calculators that are easy for you to find that you can use specifically. I've got some that are free and others that you might need to pay for. But I mean, most of the time I just use the free ones because that's what you can find, what you can use. And so I've got a few of those. The biggest thing when it comes to taking distributions that I can implore to all of you is just don't wing it. Don't wing it on taking distributions and risk, especially. Both of those two things. Have a plan. Have a semblance of what your idea is going to be. If you wait to enact a plan, that's okay. If you change the plan as you go, that's okay too. But don't just wing it. Don't just say, I'm going to take this much without really knowing what the consequence of those things are. Biggest thing. Okay, so, the three questions I just asked, there are factors that you can't control that will impact your withdrawal strategy. Obviously, not knowing how long we're going to live. That's the last question, right? For how long? How long are we going to be withdrawing this? That if we knew that, this would be easy. So not knowing that, we have to plan on being around longer than even what we think we're going to. Longer than I typically get males at least to 90 or above and females to 90, 95. Life expectancy is much lower than that, but just remember, life expectancy is an average. Half the people pass before, half the people pass after. And life expectancy for women is about 82, I believe, and for men it's about 79 and a half, right at 80 in terms of that. Investment returns. Your strategy should be flexible enough to account for those market fluctuations. Controlling that risk when you're going into your withdrawal years is incredibly important. Limiting that volatility while you're pulling money out is really important. And that we'll cover that in the case at the end. Inflation. Obviously, inflation is kind of like up and down. We've had years where it's been higher. It's coming down. Hopefully, it will continue to come. That kind of thing. We need to account for that in some ways or another. So, either that or account for your dollar buying you less. It's the same thing. Inflation, if it's not accounted for properly, it can be like, it's like death by paper cuts. You don't bleed out immediately. It takes a long time, and it's kind of painful at the end. Inflation, make sure that we're looking to that to make sure that your spending power remains the same. When it comes to that, and we talk about this on the written piece next week about assessing your risk with that. But, it is possible to become too conservative. If you have investments that can't keep up with inflation, it will erode your buying power, and inflation will take its toll, and it will be later in life. So, it's important that, if you don't have to take risk and you can still accomplish the same thing, then I'm all for that. But it's also appropriate to make sure that you have a level of risk that helps avoid that fluctuation, but also gives you the opportunity to grow above inflation for the future. And then obviously future expenses. There are some expenses that we can't control. Healthcare in some cases becomes one of those things. All of these are particularly important. So speaking of the inflation, this is really just shows you today buying power of someone that makes about 100, or a couple, however you look at it, a 55-year-old couple that's making 150,000 to be exactly. 80% of that number is 120,000. So 120,000 would be their replacement income that they're trying to get to, and life expectancy is at 90. If they're 55 years old, that's where a lot of people on the call are. This is what your income need is, but at retirement, this is how much your buying power will have to be to get the same right here and then in retirement. So if you look at that over another 40 years of what inflation does, you have to have this, spend this amount of money just to keep pace with this. So don't use that as a mechanism to try to like put fear or scare people, but just make sure that we're accounting for that in some form or fashion. Okay, so let's get into some of the withdrawal strategies. And I know a lot of you have heard of some of these in some capacity. Some of them I still use on a regular basis, like this one right here. But the 4% rule, it is true for most people that retire in their 60s that if you withdraw 4% or less from your portfolio per year, in general, most people, and in fact, I've never seen it, but most people, you will not run out of money if you are able to just withdraw that simple amount. This is a really good one for like a quick gauge to say, okay, this is 4% of my savings at retirement is going to be this. If I do that and add Social Security, how close does that get me to the expenses and to the what I want to replace my income? This is a really nice rule because that it's kind of tried and true. So long-standing retirement strategy. Many retirees value this strategy because it's super simple and it gives you a predictable amount of income for the most part every year. However, lately, this has been criticized a little bit for not considering the effects of rising interest rates and market volatility. Market volatility, though, remember, I get less into that conversation and argument. That's a short-term factor. Risk is a long-term view of what you're trying to accomplish. There's always going to be short-term market volatility. And if your portfolio is properly constructed, in terms of stocks to bonds, then that volatility in general will be lower. So, but in the event of stock market declines, if you're all equities, obviously that can deplete your resources very, very easily. As an example of how this works, if you have $1 million saved under this strategy, you could withdraw 40,000 during your first year of retirement, and then whatever you have in the second year, you would take out 40,000. Depending on how much you're making on it, but you would take out about 40,800, and so on and so forth. If because in general, over time, the returns can outpace that 4%. That's kind of the whole purpose of it all. So yes, 4% rule, super easy. I think everybody knows how to do that. Fixed dollar withdrawal. So sometimes retirees take out a fixed dollar amount over a specific period of time. For example, you might decide to withdraw 40,000 annually and then reassess that dollar amount at the end of like a 5-year period. See where you're at. If you're lower or higher, maybe you need to adjust accordingly. And while this provides predictable annual income, which is honestly easier for you to budget, in the event of market volatility and you're pulling out more than you need to, then you're paying taxes on more than you need to. If you're pulling out more in the event of market volatility, that can really impact your buying power, your spending power over the long term. So this approach is simple, and but its disadvantages are it's not the best for protecting against inflation in some cases. Because inflation, you're pulling the same amount in year 1 as you are, or year 5 as you are in year 1. So you're not taking into account goods and services rising. So that is one of the downfalls of doing the fixed dollars. Fixed percentages, very similar to the 4%, but instead of taking that out, the dollar amount of the distribution will actually vary because it's based on the underlying value of the portfolio. So it doesn't create so much uncertainty, even though it's uncertainty in how much you take from year to year. In year one, you might take out 40,000. If we have market expansion in year two, in the example of this one, you might take out 43. But in year four, with market contraction, you might be down less of that because we're taking out a fixed percentage based on what the value is at the end of the year in terms of that. This one's easy to follow, but again, you might pull less or more from a year to year. So very similar to the 4% in terms of that. A systematic approach is where you withdraw the income, such as what we were talking about before, dividends and interest. That's whatever's created. So whatever you've made on the money, basically from year to year, on the underlying investments in the portfolio. If you're able to pull this off, that's great because your principal remains intact. It doesn't change. Meaning, so if you start with $1 million and it makes 45,000 with dividends and interest, and you're taking 45,000. If it makes next year, you're still starting with $1 million. If it makes another 5%, then you're 50,000. However, it can be down because not all years go up. You do get dividends, but there might be years where you're down. And so it protects your principal, but you definitely won't withdraw the same amount every year. And in some years, theoretically, it could be much less because the contraction of your portfolio, you might not have gains in certain years. So that one's a little harder to kind of make yourself wade through it. Lastly, well, it's not last, but this is the one that I use the most. I'll be honest with you. Our firm, when we create portfolios, we use bucket strategies between fixed income and equities, and cash. And we usually have a fourth bucket in there. We kind of count cash and fixed income under the same plane in a lot of cases. And then we will have equities and what we call diversifying strategies. With the bucket strategy, you withdraw assets from the buckets. Under this strategy, the first bucket holds a percentage of savings in cash, often like 5%, 6%, maybe it's a little bit longer, depending on your need. So it really is a multiple of what your need is in cash and fixed income. Okay, that's why I count a lot of that. The fixed income it can be a separate bucket in terms of that, and then the third bucket contains the stocks. As you use the cash from your first bucket. So let's say you have 3 years of cash or 2 years of cash in that earning, some sort of, we wouldn't put it where it's earning nothing, obviously. You put it in there where it's earning, like a money market rate or something like that. But let's say you start to deplete that down. Well, you can replenish it with earnings, either yield from fixed income, so from bonds, or with earnings and dividends from your stocks. This allows you to kind of be predictable on how much you're setting aside for those living expenses. And your investments will have ideally more time to grow, or in the event of market volatility, more time to recover. And you'll see that on the case scenario that I show. So this approach, one of the advantages I really like is it allows your savings to continue to grow, whether it's in periods of growth and or periods of volatility or the market being down. The other ones also allow it to grow, but if you're pulling money from equities in those situations, you're pulling money, it never has a chance to recover if it's down. In this case, if you're pulling money from cash first and then fixed income second, it doesn't matter kind of where we're at on that roller coaster, if you will, in the short term. It gives those stocks plenty of time to kind of down. The disadvantage to this is it takes more time. It doesn't take a great deal more, but it takes more time in terms of seeing what I call runway, how much of your living expenses you have out there. As those compress, obviously you need to refund that up, and it'll make a little more sense when we do this case scenario in just a second. And then, of course, all of those strategies, these are the most common. There's a few more out there, but you can mix and match any of those. There's no one size fits all for anybody. Um, I personally like the bucket. It makes things more clear in terms of runway of living expenses and those kind of things. But I also utilize the 4% rule as a general rule in one-on-one meetings as a quick thing very quickly to kind of see, where you're at on projecting money out there. Is that going to be enough for income utilizing 4%? Nothing wrong with that. Okay, so let's get to our hypothetical scenario here, if you will. So this person or people has an income need of $75,000. Okay. At 67, their full Social Security is going to be $38,000. So, that immediately subtracts off that $75,000 of income need. So you're going to need $37,000 from your annual savings in order to maintain that need and lifestyle that they want to. This person has a 401k with $650,000 in it and has outside savings, combined just savings and or CD of $100,000. Okay. And we count all of that, by the way, right? So sources of income. So what I generally try to get people to do is have a multiple of those expenses in more conservative instruments. To me, it depends, but in general, it's 7 to 10 years, and that's an intentional number. Okay. So in this case, the need for this person or these people is $37,000 a year. So $37,000 a year will come from their savings. So let's take a multiple of that. Instead of 7, let's make it easy math. We're doing 10 years. Okay. So $370,000 I would want in more conservative or less volatile instruments, i.e. bonds, fixed income type scenarios. Okay. So what that means is, and not 10-year one way, is that if we have 10 years, 370,000, it really means that you have 10 years plus the return that a lot of those investments are going to make in terms of walking around money. So if you're 65 years old and let's say you're going and doing this, or 67, let's just keep it the scenario, 67 years old, and you start this plan that really you have at a minimum it's getting you to 77 because you've got 10 years of walking around money, but plus the return in today's terms, a 5% yield on a 5% yield on a bond portfolio would make that 10 years really almost 14 years, 13 years and 8 months to be exact on the runway of that bucket alone. So you would have almost 14 years of money in that 370 of your spending needs that are made. So if you're 67, that gets you to 80. If you're 65, still almost gets you to 80, gets you 79, right? And we still not even talked about the remaining portions of the portfolio. So you have 370,000 out of 750,000, or 49% of this portfolio I would want in conservative type instruments. That's the way I try to view with that bucket strategy. We build out a runway of what your income expenses are, and we then pair your asset allocation. This person, if they're able to do that, they might be able to go 7 years, but on 10 years, there's no sense in taking more risk than this if we can make it work, right? And so they're basically a balanced portfolio, 50-50. A 50-50 portfolio with us, we strive to make anywhere between 5.25 to 5.75. Okay, and so that depends on a couple of different factors. And if you're doing 5.25 a year, you're over 2% above expected inflation, and so $37,000 a year. This person would have over 32 years of retirement funding, which gets you well into your 90s, which is it's what we're trying to do. And we've not even talked about real estate or any other assets that they might have that if they live to be 100, that maybe they can utilize in the event if we needed to. So this is simple. It's a simple way to look at it. It usually makes sense to people. You could do the same thing if you wanted to in quick math on this. 75,000. So let's say that you could use the 4% rule. So they have 750,000 times 4% a year. That's 30,000 a year. That's a little short of the 37,000, but more than likely they're going to be fine because they're going to spend a little bit more money in the beginning of their retirement and less money as they get older. So it's really close. You can utilize, like I said, multiple ways to do that. So hope that makes sense. Super kind of simple in terms of that. Anyone has any questions about that, throw it in the Q&A or shoot me a message. But again, we got to figure out how much we're going to need to spend, what our Social Security is. We net that out. We go 10 years in terms, 7 to 10 years. The reason for that 7 to 10 years, by the way, is because the markets tend to run in cycles, stock markets. It's a backward looking metric. Those cycles tend to be from peak to peak. So from one high to the next high, 7 to 10 years. It's gone longer than 10 years a couple of times, and it's been shorter on those cycles, but from peak to peak, from one high to the next high on average is about a little over 7 years. So no matter what's happening on the stock side of things, you don't have to pull from those assets if they're down, there's a correction, it'll have the opportunity. And then as you live longer, what's going to happen is you're going to spend down that cash and maybe even some of that fixed income. Obviously, we have that, in this case, that 14-year runway, right? Well, eventually what's going to happen is your stocks are going to rise and be up, and you're going to peel the profits off of those stocks, rebalance them over into your fixed incomes, and do that in perpetuity. So one of the reasons I like doing that as well. Okay, so we just kind of talked about an asset allocation strategy, but this is really another way to look at it, how your age and risk tolerance influence that investment strategy. Obviously, if you got 25 years to retire, you can take more risk. If you're inside, 5 to 7 years, that risk should be less. And so there are a lot of rules on this. A lot of people say, take your age in terms of equities. I don't necessarily go by that, but I mean, that's not a horrible idea because when you're 80, you would have 80% in fixed income and 20% in stocks. You still have exposure to those growth instruments. So a lot of different ways to do this. But generally speaking, the further you are from retirement, the more risk you can take. And it doesn't matter. Risk when we're saving doesn't matter a great deal. And then some of you might be in these target date funds, the vintage funds. So it might be like Vanguard Target Retirement or BlackRock Life Path or whatever's in your particular plan. This is a typical glide path, so obviously the year associated with that is designed so as you get to retirement, you're close to that 50-50. This is 25 years to retirement and 0 is retirement. Reds and yellows are U.S. and international equities, and the blues are various types of bonds and fixed incomes. So if you look at that as you get closer to that retirement age, your risk already levels down, and it's designed to get you at retirement about 50-50. You'll walk into retirement about 50-50 in your asset allocation, and then it might go down a little bit more, but it'll never be to the point where it's always just nothing but bonds. So good visual illustration for those target date funds as well on that. Obviously we covered quickly the different strategies. I like the fixed percentage or the 4%, and then the bucket strategy is the one I tend to use the most. Some of that's because it pairs well with how our firm manages money in terms of those buckets. But I mean, you all can do the same. You can make it cash, bonds, or fixed income and those kind of things. This is not, unique to us, and I think it's just a nice way to visually have math determine how much you really need in that safety component of that. So reach out with any questions. You can scan this. It'll take you to my Calendly link. You can also email me. I'll have Sarah drop my email in the chat. It's Nighbert at mcfadvisors.com. So what I'm going to do now, this concludes the recorded portion of today's webinar. So we're going to stop the recording for the Q&A part of this right now, and then I'm going to answer your all's questions that we have.